All right, Marie says it's time to start, so I guess we got to go ahead and get started. So good morning, everybody. Boy, the crowds seem to be thinning a little bit, don't they? I wonder why that is. I'm curious to see what the crowds will be like after the first exam, which, by the way, is a week from today. Okay, so let me get back to that in just a second. A few announcements for you. First of all, I think I got my technology problems figured out up here, so we should have a good, smooth class today. Just a couple of reminders, standard announcements. The videos for this week will close Thursday next week, so that's nothing new. TA hours were 10 to 4:30, 10:30 to 4 o'clock every day. We may extend that a little bit next week if we start getting a big flood of students for exam help. So we're just going to take that as it comes. Big reminder, when you're emailing us, please make sure that you email us at acg3173@ucf.edu. We're still getting some stray emails in Canvas and some other things, and we need to funnel all that into one common source so we can keep track of the replies. Okay, so please make sure you do that. And also just a reminder, the TAs, and by the way, the TAs that I have, I've hand-picked these TAs, so they're very, very good. They are there to help you understand the material. They're not there to do the homework for you. I've been getting quite a few reports about students coming in there, and basically what they want the TAs to do is to do the homework for them. They're not going to do that, okay? They're there to help you understand the material. In fact, I sat in on a tutoring session this morning, and they're very, very good about that, but they're not going to do it for you, all right? So just a reminder on that. Okay, Tuesday after class, as I hope you saw, I assigned the Chapter 3 homework, so that'll be due next Tuesday. I try and give you at least a week to do the homework. So the Chapter 3 is already posted. That should be due, is due next Tuesday, so you have the week and the weekend to do that. I anticipate getting through at least what we need to get through in Chapter 5 today, so I plan on posting Chapter 5 homework this afternoon, which will be due Thursday at 7, right when the exam opens. Okay, so look for that. Like I say, in fact, I will post Chapter 5 this afternoon, regardless of how far we get. We should get as far as we need to, I hope. But regardless, I will post that today. So we'll see how far we get today. Also, I forgot to announce this. We finally the financial aid quiz. We finally got those grades straight. Now, something happened because I very early in the week, I did my little Canvas setting to fix all those grades, and it didn't do it. And I need next semester I need to figure out why. I'm assuming it's just because of the sheer number of students we have in here, but I need to figure that out. But nonetheless, the TAs actually went through and manually did it. Now there were a handful of people who didn't do it on time, so you didn't get credit for it, all right? But the vast majority did, so you should have 2 points on there. If you don't, email us and call our attention to that. But like I say, that's assuming that you did it on time, okay? Which I think there were 9 people that didn't do it on time, so the vast majority did. So double check that, and if there's a problem, make sure you email us. Okay, and like I said a couple minutes ago, the exam opens on Thursday. Pay attention. This is for the entire semester. Pay attention to the exam times, because I had an issue with the exam, as we all do with the lecture capture classes. I couldn't make the exam always close when I wanted it to, because what I wanted to do was I wanted to set each exam for 3 days and have it closed then. I couldn't always do that because the testing lab has such a demand from students that they can't have all the exams closing on the same day, because then they'd have literally 4,000 students over there trying to take an exam at 10 o'clock at night, and I think there's 175 seats or something like that. So you know how that's going to work out. All right, so they block when you can actually have it closed. So the first exam, I believe, is open for 5 days, Yeah, which I didn't want to do, but I really didn't have a choice. Okay, so they all open at the same time, which is Thursday at 7 in the morning. So they all open at the same time. The issue was when I could get them to close. Okay, so all semester long, and that's why I didn't post the exact exam times on Canvas, because if there's a mistake between Canvas and the testing lab, then we have an issue. Okay, so make sure you look at the dates on the testing lab and pay very close attention to that. I would also highly recommend, on a related note, do not procrastinate. Okay, don't procrastinate. Don't wait until I'm going on record right now. Pay attention in video land. I'm going on record right now. Don't wait until 10:30 at night of the last day and then go running over there. Okay, I imagine you will be able to get a seat, but it depends on, I have last time I looked, there's 1,011 students in this class. All right, so I would not do that, okay? If I were in your shoes, I would plan on taking it at least a day before it closes, okay? So I'm going on record right now. Don't procrastinate, all right? There's too many students. Yeah, there were a couple questions, yeah.
After we take the test, does it actually show our scores?
Yeah, after you take the exam, and that's a good question. Like after you take the exam, when you submit it, it should show you the score in the exam, but it's not going to show you which questions you got correct or which ones missed for security reasons. Okay, so after the exam is over, and by the way, they will not do this until the exam has already closed. During the exam period, the TAs will not be available at all. Okay, so you need any tutoring you want or anything like that, you need to do that before the exam opens. In other words, before Thursday. And they're not, during the exam, they're not going to be available again for security purposes. Okay, so when you submit the exam will tell you what your score is, but not which ones you missed. After the exam closes, then what you do, if you want to see your exam, which I would imagine you do, is you get with the TAs and they will pull up your exam and you can view it on the computer and you can see which ones you missed and why you missed it. And they can explain why you missed it and all that kind of stuff. Okay, so that's going to be the drill. What else was I going to say about that? Exam, submit, grades. I don't remember. No, okay. Got it? Okay. There was one other. Yeah.
In reference to the regional campuses for taking the test.
Yeah.
The same open schedule.
Yes, on the region. Is that what you're going to ask? Okay. Yeah, on the regional campus, it's the same schedule. Okay. Make sure it's the same schedule on the regional campus, but be reminded that on the regional campus you have to make an appointment 24 hours ahead of time. And I was thinking about our conversation, I guess it was on Tuesday when we had this. First of all, don't make an appointment and not show up. I mean, first of all, you don't do that, okay? But if you did do that, then probably what would happen at the very least is you're going to have to make another appointment and give them another 24 hours notice. And that might run you beyond the exam time. So the bottom line of that is don't do that. Just don't do that. But yeah, on the regional, and they're on the same schedule, so it's the same drill. You go to TAs and all that kind of stuff. Yeah.
So I have two questions. What time does the exam close on Tuesday? And do we get partial credit instead of if we miss one small?
Okay. Yeah, the exam. Look on the testing lab schedule to see exactly when it closes. 11:59. So basically midnight on Tuesday. Is that right? Okay. All right, I'm getting mixed reports up here, and I didn't look at it before class, so I don't want to go on record as saying something wrong. Look at the testing lab schedule, okay? It's on there. I guess she's got it. So look on there, and what was your other question? Oh, the exam is mostly multiple choice, and I'll talk a little bit more about this on Tuesday. The exam is mostly multiple choice, but there are a few other questions on there. There's some calculation questions where you actually fill in the blank. I know that at least on one or two of the exams, there's a couple of matching questions. So on some of those, you may get partial credit, but no, it's a computer exam, computer exam and 1,011 people in here. So partial credit, looking at your work and seeing all that kind of stuff just isn't. That's not going to work. But there is some in the sense that there's some multiple matching questions on there and that kind of thing, okay? And I was planning on talking about the exam on Tuesday, which is why I don't have my notes on it. The partial credit, matching. Oh, I know what I was going to say, is something that's very, very, very important, okay? The homework that you're doing, this is really important, so pay attention. The homework that you're doing is not a practice exam, okay? My opinion, all right? Taking a practice exam and then turning around and taking the real exam, which is the same thing as the practice exam with just different numbers, is not junior level university work, okay? The exam, of course, draws from homework, because the point of the homework is to help you understand the material. That's the point of it, okay? That's why I want you, to the extent you don't understand it, that's why I want you to struggle with it. That's why I want you to at least submit it one time before you go to the TAs to help, okay? Because that helps you understand it. So it's there to help you understand the material, but the homework is not a practice exam, okay? The exam draws from the homework, of course, but it also draws from the book, and it also draws, of course, from what we talk about in class. Okay, so that's what it draws from. However, I told you this before, and I will remind you on this. Having said that, at the junior level, I don't believe in putting things on the exam that we haven't covered. Okay, so having said all of that, everything on the exam we've covered. Okay, either in class or in homework or something. So it's not. I'm not pulling things out of left field that you've never seen before, assuming you've done all your work. Okay, yeah.
As professor, how would you suggest that students study for the exam in the best possible way, considering the homework is not an exact replica, which is
Yeah.
understandable?
Yeah. Question is how would I recommend studying for the exam? Which is a fair question. First of all, go back through your notes. Okay, and if you notice on the syllabus, I actually have the steps on there. But what I just said was, everything on the exam we've covered in class. Okay, so go back through your notes, look at the topics that we've covered, and simply make sure that you understand those topics. For example, what we're getting ready to cover here in a few minutes is current assets. All right, well, within current assets, we're going to talk about cash equivalents, accounts receivable. So go through your notes and look at what we've talked about there, and make sure you go back to the book, okay, and read what the book has to say about those topics and understand what the book has to say about those topics. And also, of course, the homework. I'm not I'm not diminishing the importance of the homework. Make sure you understand all of the homework problems as well. Okay, so yeah.
When you make an appointment, do you make it for a specific time?
You mean at the testing lab?
No, yeah, testing lab at the regional.
Yeah, at the regional campus, if you make an appointment, you make it for a specific time. Yes.
And if you don't show up at this time?
If you don't show up, then at the very least, they get mad at you. Okay. What happens beyond that, I don't know. But like I just said, I would imagine that at the very least, you're going to have to make another appointment, which is going to require another 24 hours notice. So again, I would really recommend not doing that, yeah.
Okay, I have a question. You explain something totally different, like certain topics you explain differently from how the book explains it and how we learned in prior courses.
Okay.
So the book, to be honest, is not really a helpful research because it takes you all over the place until you actually get to the topic.
Well, I would disagree with that because he's talking about the way I might present something versus the way the book might present something versus the way someone else might present something. And all of them are going to be correct. Okay, and what you want to do is you want to be able to understand all of them, because if you understand all of that, then you understand the topic. Then you understand the topic. If all you do is understand what I said, then all you're doing is parroting what I said. And you may or may not understand squat. So that's and I'll do you one better than that, the internet. Now you got to be careful because you want to stick with reputable websites on the internet, but the SEC website, stock market exchange websites, things like that are safe websites. You want to read what they have on there as well. Okay, so they should all be Correct. Now there's going to be opinions in there where, my opinion might differ from someone else's opinion, but the factual nature of the material should be correct. So if you can, and which brings up another good point, by the way, because what I said was that the homework is not a practice exam. And what I mean by that is, we may talk about it in class, we will talk about it in class, have homework. On the exam on some of the topics, I might come at it a little bit differently, because the reason you're here is to understand the material, not just regurgitate what I told you, okay, having no clue what you're talking about, all right? The point is to understand the material. So all of the studying that you do, which again goes back to wrestling with the homework and all that stuff, the point is to understand the material. If you do that, you're fine. If you do that, you're good to go. So if you do that, it really doesn't matter how I ask it on the exam, whether it's a multiple choice, whether it's a fill in the blank, whether it's a matching, it doesn't matter because you've got it. All right, one of the best pieces of advice I got was from one of my graduate professors who was, telling us that, what you should really be able to do is by, let's say, 10 o'clock the night before the exam, you get to the point to where you read it and then you close the book and you've got it. And you've got it, and you go in the next day and you take the exam. By the way, I have some, on kind of a related note, on Canvas, I've posted some study tips. This should be under course resources. If you look under there, I have some study tips that I've posted on there for you. Just things that I've learned over the years, okay, and things that seem to work for me. I mean, I don't know that there's anything really scientific to it, but they're just on there, FYI, to help you out. So read through those. Things like, if you're going to take the exam at night, you might want to study at night. Just things like that. Okay. All right. Yeah.
If we don't have the right financial calculator yet, can we just bring a regular calculator?
Texas Instrument ones, you can't bring it into the testing center.
Right.
They won't let Texas Instruments calculators in there? Really? Okay.
They think that you can actually, like, for instance, input the information
Really?
for the testing.
Okay. I'm hearing reports that the testing lab won't let you bring in Texas Instruments calculators. That's a new one on me, but we have a consensus up here, so it appears to be the truth. Go get your calculator. You want to get your financial calculator. Like I said, when we get into chapter, I forget which 7, I think it is, somewhere in there, we're going to be doing some, actually I think it's 6, we're going to be doing some things with the calculator, some advanced things with the calculator. So you want to get the basics going before that. So go get your calculator. One more and then let's move on. Yeah. The notes that I was talking about to help you study? No. Oh, yeah, the study tips. Yeah, it should be under course resources. Is it in there? Yeah, it should be under course resources in there somewhere. Okay. All right. Anything else? Going once, twice. Okay. So what we've done so far is we've kind of gotten the basics out of the way. Okay, so chapters 1 and 2, particularly chapter 2, was really a review of the material that you should have seen before, or mostly a review. There might have been a few new things in there, but mostly a review of material you've seen. I skipped chapter 4 on purpose because they cover debits and credits and all that kind of stuff. So just a reminder on the exam, as a matter of fact. I will explain things using debits and credits sometimes, because I think you should have at least a working knowledge of debits and credits, but I'm not going to test you on debits and credits on the exam. Okay, so I'm not going to get on the exam and say, prepare the journal entry for this, or, for this transaction, what would you debit and what would you credit? I'm not going to do all that. But what I will do and what you should know is the effect of transactions on the various accounts, which was the point, one of the points of the review material that I posted on there. Okay, so anyhow, I skipped chapter 4 because that was more accounting in nature. That was more for the accountants. Okay, so I skipped that, but there is some good review material in there, so you might want to skim through it if you're having trouble understanding some of this stuff. But chapter 4 per se will not be on the exam. So we're moving to chapter 5. So chapters 5, 6, and 7, I believe, what we're going to do is we're going to start looking at the individual parts of the balance sheet. Okay, today starting with current assets. All right, and looking at various ways that the information is presented on the financial statements. And by the way, what we did in Chapter 3 with those ratios, you're going to see those ratios all semester long, okay? So a common question on the exam for any given transaction that we're talking about, okay? We're going to be talking about bad debt here in a few minutes, okay? So a common approach on the exam that you can expect, and I've tried to put on the homework as best I can as well, is if a company makes this decision, how does it affect return on assets, return on equity, debt to equity ratio, so forth and so on. Because those ratios are commonly used by decision makers, both internal and external, to determine the financial health of a business. All right, that's why we're here, is to get better at that. So, common approach. You know, the accounting decision that they make, how is that going to affect the ratios? All right, so that's a blanket statement for the entire semester. Okay. All right, so let's go ahead and get started. And like I say, I think I've got my technological problems solved up here. So I'm looking very much forward to seeing how well they work. There we go. Sitting here bragging about it, I thought PowerPoints weren't going to come up. Okay, so we're starting with the balance sheet, starting off with current assets, which we've talked about before, exam review. You know that current assets are?
Cash.
Well, cash is an example of a current asset, but how are current assets defined? Yeah, assets that are expected to be converted into cash within a year. Okay, actually, it's within a year or within an operating cycle, whichever's longer. I'm not going to split that hair with you, but basically, assets that are expected to be converted into cash within a year. Okay, of course, and by the way, the most common example of a current asset is cash. Cash is always going to be the first account listed on the financial statements, assuming they have cash, which sometimes they don't. They might be overdrawn. But why is cash the first item listed on the balance sheet? Yeah.
Because it's the most liquid asset.
Okay, it's the most liquid asset, and other items all of the items on the balance sheet are listed in order of, very good, liquidity. Liquidity. Okay, so everything on the balance sheet is listed in order of liquidity, which is why cash is listed first. Okay, so examples of current assets. Cash, you know what cash is. We also talked about cash equivalents, which we'll get to in a minute, as opposed to short-term securities. Okay, so we'll get back to that in just a minute. Accounts and notes receivable. What's the difference between an account receivable and a note receivable? Probably the duration. But outstanding. Accounts receivable are what the customers owe the business. So that arises in their normal course of business. Notes receivable is something else. Okay, but if they're due within a year, they are current. Inventory, you know what inventory is. What are prepaid expenses? Yeah, insurance, rent, those are examples. Remembering our definition of accrual accounting, prepaid expenses are expenses that have been paid but not yet incurred. Very good. Such as rent, insurance, etc. Okay? All right, so some examples of cash equivalents. A good question came up the other day about the difference between a cash equivalent and a security. All right, and the difference generally is that cash equivalents are securities that have been purchased with a maturity 3 months or less. Okay, so they're very near to the maturity, right? As opposed to marketable securities, which would have a maturity of greater than 3 months when they were purchased. Okay, so some cash equivalents. They say U.S. Treasury securities. Most of the time, that's probably going to be T-bills. Okay, and what are Treasury bills, Treasury notes, and Treasury bonds? What are they? If you're taking 34-3 or you've had it, you should know this, because you'll talk about it quite a bit over there. Treasury bills, Treasury notes, Treasury bonds. What are they? Money given to the government. Yeah, you're expecting a return. Somebody clean that up for us. Ooh. Yeah, a tricky way to say it, he said a guaranteed rate of return, which for practical purposes, yes. I have trouble with the guaranteed part of that, but for practical purposes, yes. Yeah. Least likely to default, which is kind of the same thing as guaranteed. So yeah, Treasury bills, notes, and bonds are debt of the federal government. That's what that is. Okay. So if you buy a Treasury bill, Treasury note, Treasury bond, you are literally lending money to the federal government. Okay. This $17 trillion or whatever we're up to now in debt, that's what we're talking about. Treasury bills, Treasury notes, Treasury bonds. Okay. So if a company owns this, they have literally lent money to the federal government. And the reason they do that is because, well, I mean, I guess there could be several reasons, but probably the most common reason is they have a sudden and unexpected inflow of cash. So maybe they collected a lot of their receivables quicker than they thought they were going to. And they can't invest the money because they're going to need it for their operating expenses, but they want to earn a little higher return on the money. Okay, so they'll park it in Treasury bills for 60 days or something like that. Okay? All right, so cash equivalents, Treasury bills, certificates of deposit. I imagine you all know what those are. They're basically, it's like a savings account at the bank, except you agree to leave your money in there for a certain amount of time. And if you take it out early, you get penalized for it. But if you leave it in there for the agreed upon amount of time, you get a higher interest rate than you would in the savings account. Okay, so a company can also use those, and also money market mutual funds are considered cash equivalents. What in the heck are those things? Money market mutual funds. Okay, they're mutual funds. They're not going to be invested in currency, probably. Yeah. Yeah, exactly. Exactly. It's a mutual fund that's invested in the money markets, quote unquote, and the money markets consist of short-term, highly liquid debt instruments. Okay, some key words on that, and that's a good opportunity to try out what I hope will solve our problem from last time. Okay. So the money markets consist of short-term, all right, key words, highly liquid, debt instruments. Short-term, highly liquid debt instruments. Okay, which, noting, would include Treasury bills, and would include certificates of deposits. So if they might buy the Treasury bills and certificates of deposit individually, or they may buy them through a mutual fund. Okay, because what they're doing is they're actually putting money into a mutual fund, which is turning around and putting the money in, spreading it across those instruments. Okay. All right. And what else did we have up here? Cash. We had money markets, certificates of deposit, that was it. So questions about that? Yeah.
Well, can you say again what's commercial paper?
Oh, I'm sorry. Commercial paper. What is commercial paper? I beg your pardon? No, it's not cash or paper money. No, it's short-term debt for corporations. For corporations, okay? So if a corporation is trying to raise money on a short-term basis, they'll sell what's called commercial paper, okay? So T-bills are debt of the federal government. So if a company buys T-bills, they're lending money to the government. If a company buys commercial paper, then they're lending money to another corporation. Okay, yeah. Well, again, the incentive to do that is they're looking for a place to invest excess cash on a short-term basis. Now, keeping in mind that the money we're talking about here, we're not talking about $10,000. I mean, we're probably talking, tens, if not hundreds of millions of dollars. I mean, Apple, I haven't kept track of it, but last I heard, Apple had, I think, $176 billion in cash. Okay? So we're talking about big money, which is a problem because CDs, for example, when you buy a CD, that's the insurance on that is they're only insured up to $250,000, which, by the way, went up from 100 as a result of 2008. So for each bank, okay, the CD they buy, they can only put $250,000 in there on an insured basis. So if they're looking to park $50 million for 2 months at a little higher interest rate, yeah, they're probably not going to be doing it in CDs, okay? But they could do it in bills, commercial paper, mutual funds. Okay, so that's why they do it, is to earn a higher return on excess cash that they don't need at the moment.
And so, like, if Apple were to do that, they wouldn't help Microsoft. They would help maybe someone who's a partner in making their products.
Well, they might help Microsoft if Microsoft was issuing commercial paper. I mean, they might help them in that sense. You know, I mean, if they lent money to a specific, if you had a corporation and you lent money to me, then that would be a note receivable. That'd be a note receivable. Okay. All right. Other questions? These are good questions. Good. Yeah.
I still don't understand the difference between money market mutual fund and then the CDs.
Money.
Both of them put together?
No, money market mutual funds, the simple way to look at it is these are mutual funds that invest in all of those things. Okay. So you're a corporation, okay? You could go out and invest money in treasury bills, CDs, commercial paper, or I have a mutual fund. So instead of doing all that, you could simply put your money in my mutual fund, and I take your money and her money and his money, and I pool all that together, and I turn around and I purchase all of these for you.
With the mutual fund, you are able to do both of those, but you have to stay cash.
I guess that'd be fair, yeah. Yeah, with a mutual fund, you invest in all of them. You'd own a little piece of all of them. Okay, which is one of the points of the mutual fund is diversification. Okay, all right, one more and then let's move on, yeah.
What about the concept of a blind trust?
The concept of a blind trust?
You know, where they, isn't that where they just invest the money for you and you have no control?
Yeah.
Do you have any control in a mutual fund now?
You mean over where it's invested?
Investment?
Well, you have control over what they invest in by the fact that you picked the mutual fund in the first place. Because there are tons of mutual funds out there. Okay, these are just, this is just one example. There's mutual funds that invest in money markets, that invest in the capital markets, that invest in currencies, commodities. I mean, pretty much anything you can think of, there's a mutual fund out there for it. So you do control in the fact that if you want a higher rate of return than this, then you don't buy this in the first place. Make sense? Okay. All right, good questions, good questions. So, all right, so cash equivalents, a very important part, especially with cash. And I think it would be fair to say that this isn't, I don't want to say it's less important, but with the use of debit cards and Apple Pay and all that kind of stuff now, there's probably a little less, I'm sure there's less cash changing hands than back in the day, but control over cash is essential. So what companies will have, this is important for the audit process, by the way, but for all of their systems, particularly cash, companies will have what's called an internal control system. All right, they'll have internal controls to make sure that transactions not only get into the accounting system, but that they're also recorded correctly once they're in there. In fact, a common way to audit a company is that for any given internal control, when the auditors go out there, what they'll do is they'll purposely introduce an error and then see if the control picks up that error. Okay. So I just wanted to mention this to you. There's some examples of control over here. One other that, or actually a couple of others that you may have noticed in your everyday real life is sometimes when you're paying for something, you'll see a sign that's something to the effect of, if you don't get a receipt, tell the manager and you get a free cup of coffee or whatever the case may be. Well, the reason for that is because if you pay in cash, instead of the clerk taking it and putting it in their pocket, in which case they don't ring it up on the register, therefore they wouldn't have a receipt, they want to make sure the cash actually gets into the register. Because at the end of the night, they need to balance the register to how much cash is actually in the drawer. That is an internal control system. okay, to make sure that it gets in there. I used to have a client, and they had a cookie shop, and they actually had in the office area there. So let's say that you guys are all the workers in the cookie shop, and this is the office for the manager. He had a window with a one-way mirror. So if you looked at it, you saw yourself, but in here, he could look at it and see. So you never knew if he was in there looking at you or not. And that was right behind the front desk where they ring everything up. Okay, so just some examples of internal controls. Was there a question about that? Questions? Okay. All right. So like I say, for our purposes, not really a big deal. Just wanted to mention that to you. We just distinguish cash equivalents from short-term marketable securities. Okay, so some examples of short-term marketable securities are bonds. We just talked about what bonds are. They're simply debt. Okay, so if it's treasury bonds, then that's debt of the federal government. In other words, the United States Treasury. Okay, if it's a corporate bond, then that's debt of a corporation. Okay, which gets back to the question about helping out Microsoft. All right, well, if it's a Microsoft bond you're buying, then you're kind of helping them out because you're letting them borrow money. They're also paying you interest. All right. So bonds, the securities are, of course, readily marketable, which is what makes them liquid. What is liquidity? How do we define liquidity? Go ahead. Okay. A few keywords here. So liquidity, we can define liquidity as the speed and ease with which an asset can be converted into cash okay, all right. Without, this is my favorite example. I have a car out in the parking lot right now. Could I convert that to cash quickly and easily right now? Yeah. If I did what? Yeah. Sell it for $1. Okay. Anybody in here would give me $1 for that car? Because even if I'm driving the biggest jalopy that's ever been on the roads, you can pull the tires off of it and sell it for more than that. Okay. So that does not make it liquid. Okay. Liquidity is the speed and ease with which an asset can be converted into cash without a significant loss in value. Without a significant loss in value. All right. Now, if you really wanted to nitpick, which as you progress through your education you will do, we could have a conversation about what constitutes a significant loss in value. For our purposes, it'll be a common sense definition. But liquid assets are assets that can be converted into cash quickly and easily without a significant loss in value. Okay? And that's what these marketable securities are. Okay? Yeah.
You're going to consider the market value of the car to know if you're experiencing a loss or the value of how much you bought it.
Well, the market value of the car would drive whether you have a gain, whether I had a gain or loss on the car. That's for sure that. But my point was I could sell it right this second if I wanted to. I could sell it within the next 30 seconds if I wanted to, if I dropped the price low enough. Okay. And by the way, for those of you who have a interest in investing and trading, that's an extremely important concept. So when you get to that stage of the game, pay attention to the markets that you're trading. Pay attention to how liquid those markets are. Okay. All right. Current assets and by the way, marketable securities may or may not be current assets depending on how long they're expected to be held. Okay, so you can also see marketable securities held as long-term assets. I think probably you would usually see them listed as current assets because the business is not in the business of trading securities. Okay, now if they were, that's a different conversation. But for non-financial firms, they're not in the business of trading securities, so they're probably not buying them for the long term anyhow. But you could see some exceptions to that. Okay, so you could see them listed as long-term assets. All right. Marketable securities generally are going to be held at fair market value, but It depends on how they're listed on the financials, and this is one of the, this isn't even an estimate, this is simply a decision that the company makes. Okay, and they could be held on there two ways. If they're held, let's see, if they're held to maturity, if they're what's called held to maturity, then they're actually going to be listed on the balance sheet at cost. Okay, so it's simply a declaration that the company makes, and you would see this in the notes to the financials. Okay, so if the marketable security is quote unquote held to maturity, okay, that means they don't intend to sell it. Okay, the maturity is coming up very quickly. All right, therefore, it's going to be listed at cost. Okay. By contrast, if they have them listed on there as quote unquote available for sale, then they'll be listed on there at fair market value. Okay. And the reason for that is either they're planning on selling them, which is why they're declaring them available for sale, or the fair market value is very highly volatile. Okay, with, if you buy a 28-day T-bill, all right, the maturity on that is pretty darn quick. There's probably not going to be a real big fluctuation in price on that, so that would probably be listed at cost. Okay, but a 30-year bond, okay, especially we have the Fed meeting coming up where interest rates kind of jump around a little bit, that's something that would probably be held at fair market value. Okay, so that is generally how they are listed on there. A transaction you need to be aware of this, excuse me, as they're holding these particularly debt instruments, they're going to be earning interest. All right, so they at the end of the year they may still have the bond, let's say, okay, but they've earned interest on the bond even though they haven't received it yet. So what you're going to see on there is accruals, and the good part of that is that the effect of the accrual is, I think this is a fair statement, always going to be the same, okay? And the effect will be at the end of the period, they're going to have some interest receivable, and they're going to record some interest income. Okay, so that's what you're going to see at the end of the period. All right, so this is where, maybe on December 15th, they bought a 30-day T-bill. Okay, well, come the end of the year, December 31st, they've earned interest on that, but they haven't received it yet because it's not going to mature until January 15th. All right, so they've earned the interest, but haven't received it yet. All right, accrual basis, so they'll recognize the income and the corresponding receivable. Yeah. Interest income. So interest receivable would be a current asset on the balance sheet. Interest income would be on the income statement. Okay? Other questions about that? I'm being sincere. Other questions? Got that? Okay, so that, and by the way, we're going to do some more with that when we get to notes receivable here in a few minutes. Okay, so I knew I had an example, I just didn't know if I had it right here. So that's cash and cash equivalents. Next on the balance sheet will usually be accounts receivable. Accounts receivable, okay? And we've talked about accounts receivable quite a bit already. One of the things that I want to remind you of is that this was the first example I used of estimates that are in the financial statements. Okay, so we've already talked about the fact that if you have some sales this year that you don't collect till next year. Okay, we've already talked about the fact that recording them this year more properly reflects the underlying economic reality of the firm. Okay, but I don't remember the numbers that I used in the example, but let's say you have $400,000 in receivables. Okay, are you going to collect all that? No. We all know that. Okay, so to most properly reflect the underlying economic reality, you're going to have to reduce it by a particular amount. The problem is you don't know exactly how much you're not going to collect. You don't know how much is uncollectible. Okay? Therefore, the best a company can do is estimate. That's the best they can do is estimate. Okay? And what they should be doing is estimating to most properly reflect the underlying economic reality. Whether that's what they're doing or not is something you have to determine when you're looking at the company. Okay? So uncollectible accounts, uncollectible receivables is really the big issue here. Okay, so let's see where we are. We talked about that. We don't know how much it is. We talked about that. Okay, so when they estimate their uncollectibles, okay, the entry that they're going to make is always, I don't use that word very often, I think it's appropriate here, always this entry here, except which one gets debited and which one gets credited depends on the estimate. Okay, but I think it would be fair to say that most of the time, this is the estimate that they would, or this is the way they would record the estimate. All right, so they have some receivables. Okay, we already know that not all of them are going to be collected, so they need to estimate which ones are not collected. Whatever that estimate is, they're going to go ahead and recognize the expense of that this year under exam review, the matching principle. Because remember, the point of matching is to match the expenses in the same period from which the revenues are derived. Okay, so if they're recording the revenue this period, then they want to match the bad debt expense of that revenue in the same period. But again, it's just an estimate. Okay, so they would record, so bad debt expense would go up. In fact, I'm arguing with the publishers of your book about this. I'm doing some review work for them, and I take issue with the way they present this here, but that doesn't concern you. Bad debt expense is going to go up, and the other side of it would be allowance for bad debts. What kind of an account is that? Does anybody remember? Outstanding. It's called a contra asset account. A contra asset account. So the allowance will be an asset account, but usually asset accounts increase assets. This would actually decrease assets. This would decrease assets. Okay, and you'll see that in just a second. So far, so good? All right. There's, excuse me, at least two methods, yeah.
Would that be a liability pretty much?
The allowance for bad debt account? No, that is not a liability. Well, I see what you're saying, but no, it's not really a liability because it's not an obligation of the firm. Okay? What it's doing is it's reducing the book value of the asset. Because remember, an asset is a resource expected to pay a future economic benefit. But not, in my example, not all of the $400,000 is going to pay a future economic benefit. So it's reducing the asset by that amount. I see what you're saying and whether or not it's a liability, but no, it's not a liability. Okay? All right, good question, by the way. All right, two ways to, at least two ways, there's actually probably, there's more than this, but two ways that companies estimate their bad debt. The first of which is called percent of sales. The percentage of sales method. And this is pretty darn simple. They sell however much they sell this period. They expect 2% of, so they sell $100,000 this year, or this month. They expect 2% of that to be uncollectible. Therefore, the bad debt expense that they record for this period is $2,000. Okay, so they would make, well, I'm sorry. Right there. They'd make this entry right here for $2,000. So on the income statement, they'd have bad debt expense of $2,000, and on the balance sheet, their allowance account would go up by $2,000. Okay, that's pretty simple. Okay. The other way is what's called aging of accounts receivable, and this is based on the idea that the longer a receivable has been outstanding, the less likely they are to collect. Okay, so when Kelly and her colleagues are making these calculations in the real world, accounts receivable that are due within the next 30 days, probably most of them are going to be considered good receivables. Okay, so most of them will be collected. An account receivable that might be on the books for 10 months, probably not collectible. So they would probably be inclined to start writing those off. Okay. So that's two basic different ways. What's interesting about this is notice that the percentage of sales method is an income statement approach. Okay, so the percentage of sales method is focused on net income. All right, so it's not really worried about the allowance account. All right, it's making this entry every time. Okay, the aging method is focused on the balance sheet. Okay, so the aging method is focused on the balance in the allowance account. All right, so to be clear, the percentage of sales method is focused on the balance in the bad debt expense account every period, and it's not worried about what's going on in the allowance account. The aging of receivables is focused on the balance in the allowance account, and it's not worried about what's going on in the bad debt expense account. Okay, so under the aging method, as they're adjusting this allowance account to whatever they think the correct balance should be based on the aging of the receivables, okay, they may actually have a negative bad debt expense in a given period because the entry might be reversed if they need to reduce this allowance account. Okay, yeah?
Is it possible to adjust it in the middle of the period?
Well, I mean, it would be possible to adjust it in the middle of the period, but they wouldn't do that. This would be considered one of their adjusting entries, and they do this at the end of the period. I mean, yeah, it would be possible, and what would be more probable is if they got confirmation that an account was actually uncollectible. Because remember, so far, what we're doing here, or what they're doing, is estimating whether or not an account's going to be collectible. We haven't talked yet about when they actually find out that an account is uncollectible. Okay, so tricky question, but yeah, it'd be possible for them to do it in the middle of the period, but they usually wouldn't do it. They do it at the end of the period. Okay. All right. Okay, so this is the way that it will generally be presented on the balance sheet. Okay, and I say generally because if it's a smaller balance sheet, you would probably see this detail. But on bigger balance sheets, in fact, we were just looking at one in class yesterday, you're probably not going to see the top two lines. All you're going to see is the net. Okay? And it will say something to the effect of net accounts receivable. I told you before, on financial statements, always pay attention to the word net. Always pay attention to that word. Okay? Because on the balance sheet, if all you see is net accounts receivable, then you know that that is the gross accounts receivable, net of the allowance. Net of their estimate of what they think will be uncollectible. Okay, so the allowance, it's like a holding account. I mean, it's like a holding account. Okay? So what they have on here is the net realizable value of accounts receivable. This is also, and probably more commonly, referred to as the book value. Okay, so this is the book value of the receivables. In other words, the value that's as carried on the books. Okay, yeah. Oh, well, yeah, that's a tricky question. He's asking if the book value is the amount they would sell it for. It's common, if a company gets into a cash crunch, it's common for them to sell their receivables to raise quick cash. But let's say you have that company and I'm willing to buy the receivables. Well, if let's say the book value of your receivables is $80,000. Okay. Well, if I'm willing to buy all of those receivables and you're expecting to collect $80,000, then would I pay $80,000 for that? No. I'm going to pay something less because I'm in it to make a profit. Okay. So if I was going to buy them from you, I would buy them for less than $80,000. How much less? You'll learn how to make those calculations over in 3403. But this is the amount, the book value is the amount they expect to collect. Okay. Other questions? I'm being sincere. Other questions? Okay. Let me see how I want to do this. let me try it this way. Okay, so here's how the allowance account flows from one period to the next as follows. So at the beginning of the year, beginning allowance, so this is on the balance sheet. Okay, so at the beginning of the year, they have a particular amount in the allowance account. All right. That amount will be increased by bad debt expense, and it will be decreased by the accounts that are actually written off. So every period, all right, you have the beginning allowance account. That account will be increased by however much bad debt expense they have. That's the entry that you just saw. Okay. But then as they learn of accounts that are actually going to be written off. Okay, so let's say someone that owes them $10,000 sends them an email and says, hey, you guys are a bunch of bums. You ripped me off. I'm not paying you a dime. Okay, I'll see you in court. Okay, if they get that letter and they actually expect that account to be written off, then what they're going to do is they're going to reduce the allowance account, and my example was $10,000. And they'll also reduce the receivables. Okay, there's another slide that you'll see of this in just a minute. Okay, so when they actually learn that an account is no good, then this is the entry that will be made, which will reduce the allowance account. Yeah.
So what does that EFF stand for?
EFF. Oh, no, written off. Right, written off. Written off. Accounts written off. Okay. Other questions? All right. For example, exam question. And let me jump over here 1 second. Beginning in 2515. Okay. So let's say exam question. Beginning of the year, a company has $25,000 in their allowance account. Oh. Thank you. That. Beginning of the year, they have $25,000 in their allowance account. At the end of the year, they have $15,000 in their allowance account. I know. Hang on. 15,000. This is one thing I didn't plan for. So we'll get it. And during the year, their bad debt expense was $30,000. Okay. So you're looking at a company. All right. Their allowance account at the beginning of the year was $25,000. At the end of the year, it was $15,000. You look over on the income statement, you see bad debt expense of $30,000. Okay. Exam question, how much accounts receivable did they write off during the year? How much did they write off? Get 40,000? 15. Bad debt of 30. I'm making some notes here so I can look at my notes. Here. Okay. And you got 30,000? 40,000. 25, 15, and 30. Okay. Well, the way we flow from the beginning, so the flow is beginning allowance plus bad debt expense minus the write-offs gets us our ending. Right? Well, beginning is 25,000. Ending is, beginning is 25, ending is 30, and then the bad debt expense, oh, I screwed up my example. Eraser. So the ending is 15? Okay. Yeah, the jumping back and forth was one thing I didn't anticipate. So the ending was 15, and bad debt expense is 30. Is that right? Is that what I gave you? Thank you. Killing me. So the bad debt expense is 30. Okay. So the question is, how much was written off? Okay. And the answer would be $40,000. That's how much they wrote off during the year. Yeah.
How would you deduct it from their accounts receivable?
Yes. Yeah. So what they did during the year was their allowance went down by 40,000, and their accounts receivable also went down by 40,000. So this is the entry they would have made during the year. Okay. Oh my gosh. Yeah. 25 plus 30 minus 15. Yeah. That's how we got 40,000. Yeah.
Can I take it like there'll be like different forms, like find the expenses, getting allowance and everything?
Oh yeah, I could. Yeah, on an exam question like this. Yeah, I mean, I'm giving you 3 variables and you solve for the 4th. Yeah, of course. Now I might package it a little bit differently, but the point is to understand how we go from the beginning to the ending. Okay. One more. Yep. Well, was there no? Yeah. Yeah. Yes. Yeah. So when they write it off, this is the entry they're making right here: debiting allowance, crediting the receivable. Yeah. Okay. Other questions? Okay. Next exam. Oh yeah. I'm sorry. Yeah.
How did you formulate the question?
How did I formulate the question?
What was the question?
The question was, how much accounts did they write off during the year? That was the question. Okay. My next question is, as a result of writing off this $40,000, how will their return on equity be affected? Okay. Return on equity is a common measure of return. In fact, it's kind of the beginning measure of the return to shareholders. Okay. So as companies are making transactions, they certainly want to be aware of how that ROE is going to be affected by the transaction. And us as decision makers outside the company, we want to understand how that's affected. So when they write off this $40,000, how will their return on equity be affected? Okay, so what he's saying is receivables are going down by 40,000, therefore net income would be going down by 40,000, therefore it would decrease. Is that correct? Okay, I'm glad we're covering this. First of all, what is return on equity? How do we calculate that? Net income divided by average equity. That's on your homework. It's in chapter 3. We talked about that last time. Okay. So this is how we define, or this is how we calculate return on equity. Okay. So, very important. Everybody listening? Okay. This is decision maker stuff. All right. So when they actually write this receivable off, the allowance account, what type of account is that? That's a contra asset account. Accounts receivable, what type of account is that? That is an asset. So 2 asset accounts are what's being affected. Therefore, is net income affected? No. Is equity affected? No. Therefore, return on equity would not be affected. Okay? Because remember, when the revenue for this account was recognized when the sale took place. So that's when the income statement was affected. Okay? When they estimated the bad debt expense, that expense hit the income statement. So that's when return on equity would be affected. Okay? That's the matching principle. So presumably that happened last period. Okay? This period, all they're doing is writing off the actual receivable. Okay? So they no longer have an asset, and they're taking it off the books. Right? So return on equity would not be affected. That question right there is typical of what you can expect all semester long. Okay? When they do this, how is our information affected? Us as decision makers, how's our information affected? Okay? Questions? Questions? Yeah, way downtown.
Is there any scenario in that example where the return on equity would be affected?
I mean, that's a very open-ended question. Yeah, there's lots of scenarios where return on equity would be affected, not by writing off accounts receivable, though. I hope that answered your question. That's kind of an open-ended question, but not from this, no. Okay. Other questions? Yeah.
I said somebody called and said they're not going to pay this certain amount of money.
Uh-huh.
And then they called you back and said they're going to pay it.
Okay. Yeah, after they write off a receivable, if it subsequently becomes collectible, so maybe the guy has a change of heart and says, yeah, I'm sorry I called you a bum, and I'll pay you your money. Okay, so if that happens, then what they would do is simply undo this. When I say undo, they'd make a second entry where they're debiting accounts receivable, crediting the allowance, so they're reinstating everything.
Did you just have it opposite entry?
Okay. This is what they would do here, all right? So if, they told him, yeah, $40,000, you'll never collect it, so they write it off, okay? So subsequently, the guy has a change of heart. Yeah, I'm sorry, okay, I'll pay you your $40,000. Then what they would do is they would reverse it, okay? So they would put that on there, and then when they actually collected it, cash, 40, and then the receivable for 40. Okay? And that's what they would do. Okay? Noticing that none of that affects the income statement because the revenue and bad debt expense has already been recorded in a prior period. Okay? So, yeah. When you want to credit bad debt expense instead of allowance. Yeah, it will raise the allowance because they're putting things back the way they were before. And then they're collecting it. I beg your pardon? No, you decrease the allowance when you write off the receivable. Because that's why I say the allowance is like a holding account. It's like a holding account for debts that they expect to be bad. Okay, so when the customer tells us to go jump in a lake, then you take it out of the allowance and off the receivables. Okay, but if they subsequently have a change of heart, then you undo that. So you put it back in the receivable, put it back in the allowance, and then when they collect it, cash and receivables. Okay, yeah.
Probably a random.
I'm listening to you.
Random scenario.
Mm-hmm.
They forgive you, and after they call you, they say that screw on what's going on, don't pay you, and you record the bad expense. The next month period, they say, oh, well, we're sorry.
That's what we just did.
I'm just saying it would be different if it was different periods. You record.
No, regardless of whether this happens in the same period or different periods, this is what would take place. Okay. Now, the impact, if it all happened in the same period, then it's all happening in the same period. So the impact might be a little different, but this sequence is still what would take place. Okay? Okay. Other questions? All right, one more example, and then we'll call it a morning. Let's see what I want. Let me do it this way. Erase all ink on slide. I like that part of it. Okay, so let's say we're looking at the end of the year 2014, end of the year 2015. Okay. Assets. At the end of 2014, they had $200,000 in assets. End of 2015, they had $220,000 in assets. So $200,000, $220,000. Yeah, end of the year. End of the year. So December 31st, 2014, December, yeah. If it'll make you feel better, you can say 13 and 14, since we're not at the end of 15 yet. But end of the year. Okay. During 2015, net income, $30,000. $30,000. All right. During 2015, what they should have done, or what they meant to do, was to estimate bad debt expenses of $2,000. $2,000.
That was for a year, right?
That's for the year 2015. What? All right. For 2015, they expect to write off $2,000. Okay. My question to you is, what would their return on assets ratio be if they neglected to make this entry, and then if they did make the entry? Okay. So what would return on assets be if they didn't make this entry and they did make the entry? Okay. So what I'm going to do is I'm going to let you work on that, and we'll start at this point on Thursday. Okay, so this is where we'll start on Thursday. On Thursday, we should be able to finish, or I mean on Tuesday. I don't know what day it is anymore. Okay. So on Tuesday, the next class, all right, we'll pick up at this point. So on Tuesday, we will finish chapter 5. I'm going to go ahead and post the homework today for chapter 5 that'll be due next Thursday. Just understand the tail end of the homework on notes receivable we haven't talked about yet. Okay, so you're probably not going to be able to do all of the homework until after Tuesday, but you'll be able to at least get a good start on it. Okay, so I'll post that later today. We'll pick up there on next class. See ya.